everyone, welcome back to Curious Minds. Today we are taking a deep dive into a topic that's probably on a lot of your minds right now, market fluctuations,
Hmm.
and how to protect your financial well-being when things get a little rocky.
It's a good one.
Yeah, you've probably seen the headlines talking about massive sell-offs or even using words like bloodbath to describe what's happening out there. Yikes. And of course, the dreaded bear market term is getting thrown around again.
Yeah.
So we're going to try to cut through all that noise. We'll look back at some, past market events to see what we can learn. We'll talk about why it's usually not a good idea to panic and sell everything when you see red. And then we'll dig into how your age, how close you are to retirement, really changes the game in terms of strategy. And then to wrap things up, we'll explore some rebalancing strategies, ways to use these market swings to your advantage. Hopefully you'll walk away from this deep dive feeling a little bit more confident about your financial future.
Absolutely. Knowledge is power, right?
Exactly. It is. So, I've been seeing those terms like massive sell-off, bloodbath even.
Yeah.
And then people start talking about a bear market, and it can feel like we're in some kind of uncharted territory, right?
Yeah, definitely can feel that way.
But, the interesting thing is that these sharp downturns, this volatility, it's not exactly a new phenomenon, right?
Not at all. I mean, the market is always going to have its ups and downs, as one financial advisor I was talking to put it. I mean, we've seen this play out time and time again. I mean, think about the 2008 mortgage crisis.
Oh, yeah. Everyone remembers that one, right?
That was a big one. And even more recently, we saw a pretty sharp market dip when the COVID-19 pandemic first hit.
Yeah, that was definitely a roller coaster.
Right. But the interesting thing, and this is where looking at market history can be so insightful, is that the market is cyclical. It are these ups and downs, but there's a long-term upward trend over time. There was an analysis of the S&P 500 over the past 50 years, and it found that the odds of positive returns in any given year are actually pretty good, about 70%.
Wow, 70%. So even though we have those dips, those scary moments, the odds are still in your favor over the long run. That's actually really encouraging to hear.
Yeah, and I love how that advisor put it. He was talking about these amazing green days that often follow those downturns.
Amazing green days. I like that. So you're saying that while things might feel painful right now, and they do, while the current situation might feel pretty rough, it's not necessarily a sign that the sky is falling or that we're headed for another 2008.
Yeah, another strategist I follow is saying the sky is not falling and it is no 2008 either. Things are different. You have to keep that bigger picture in mind.
It's like, don't freak out just because your GPS reroutes you. You'll still get where you're going. Yeah.
Exactly. The destination hasn't changed. And this is where understanding that historical context, I think, can really help you avoid making some emotional decisions that you might regret later. Especially when it comes to selling during those market drops.
Right. Because when you see your portfolio in the red and all the news is doom and gloom, that can be so scary, especially if you're, maybe not as experienced with investing.
Yeah, for sure.
It's like that natural instinct is to just get out, to stop the bleeding,
Yeah, it's a powerful emotion.
But that's where I think things get tricky.
Yeah. Because when you sell low, when you're feeling that panic, you're essentially locking in those losses.
Right.
What was a temporary dip could now become a permanent loss.
Right. So you're not just stopping the bleeding, you're actually making the wound worse.
Yeah, and one of the articles I was reading was talking about how important it is to have that long-term play in mind and to not let short-term volatility take you off course.
Yeah.
Stick to your plan.
It's so easy to get distracted, though.
Right? Oh, absolutely. Especially when fear takes over. It's like there's this cycle of emotions that investors go through. It starts with all this optimism, maybe even euphoria. Then as the market starts to fall, you get this anxiety, denial, and then you hit panic and desperation.
Yeah, it's all downhill from there.
And that's exactly when a lot of people sell at the worst possible time, missing out on any potential recovery.
Right. So you buy high when everyone's feeling good, and then sell low when everyone's freaking out. That's like the opposite of what you're supposed to do. It's like buying high and selling low.
Exactly. Not a recipe for success.
And, it made me think of this one article that said, very few people can actually beat the S&P 500 over the long term.
That's a great point, yeah.
So maybe for a lot of us, the best approach is just to stay invested, ride out those waves, and not try to, time the market perfectly.
Yeah, timing the market is so difficult even for the pros. Staying invested, weathering the storm, that's often been the most effective strategy historically.
It's kind of like the tortoise and the hare, right? Slow and steady wins the race.
Like that, yeah.
Okay, so We've talked about the historical perspective, the dangers of panic selling, but let's shift gears a bit and talk about how this all plays out differently depending on where you are in life. You know your age.
Absolutely. Your time horizon, how close you are to retirement, makes a huge difference.
Right. Because someone who's decades away from retirement probably doesn't need to sweat these short-term dips as much as someone who's planning to retire in the next few years.
Exactly. So let's start with those folks who are nearing retirement, 10 years or less, or maybe they're about to start tapping into their retirement savings.
Okay. So they are in the final stretch. What should their focus be?
Well, for them, it becomes less about growth and more about protecting what they've built and ensuring they have the income they need. One advisor I was talking to put it really well. He said the priority for this group should be understanding their income needs and making sure they have enough to cover their short-term goals. So let's say anything they need in the next 12 to 18 months. You know that money needs to be in something that's very liquid and safe.
Okay. So things like money market funds or CDs.
Exactly. And sometimes people call this type of investment chicken money.
Chicken money.
Yeah. It's like the money you need to sleep well at night, knowing that it's not going to disappear with a sudden market drop. It's low risk.
Chicken money. I like that. It's
Yeah.
very visual. So I also remember reading something about rolling over old 401ks into IRAs as you get closer to retirement. What's the thinking there?
Yeah, so 401k plans, especially older ones, can sometimes have limited investment options. And those options might not be the best fit for someone who's trying to be more conservative with their investment.
Right. They might not have those chicken money options.
Exactly. So by rolling that money into an IRA, you typically get access to a much wider range of investments. So you can really customize your portfolio to fit your risk tolerance and your goals as you get closer to retirement. Maybe shift to a more conservative asset allocation.
So more flexibility and more control.
Mm-hmm.
Got it. Now, on the flip side, what about those of us who are further away from retirement? Those with 20, 30, 40 years until they need to tap into that nest egg.
Yeah, that's a whole different ballgame. For those folks with a longer horizon, market downturns can actually present an opportunity. It's a chance to buy low and let it grow. You have time on your side. So even if the market takes a hit, you've got plenty of time to recover and even come out ahead.
So rather than freaking out, they can actually view this as a sale.
Exactly. And this is where a strategy like dollar cost averaging can really shine.
Dollar cost averaging, that's a term we hear a lot, but it's worth breaking down.
Absolutely. So basically, instead of trying to time the market and invest a big lump sum all at once, which is risky, you invest a fixed amount of money at regular intervals. So maybe every month or every paycheck.
Okay, so consistency is key here.
Right. And the beauty of this is you're automatically buying more shares when the market is down and fewer shares when the market is up. And that can help you average out your purchase price over time.
And you don't have to be a market wizard to do it.
Exactly. It takes the guesswork out of investing.
I like that. Okay, so we've covered historical context, the pitfalls of panic selling, and how your age plays a big role. What about this idea of rebalancing?
So rebalancing is all about staying aligned with your investment goals. Even if you have a long-term plan, the market can shift things around. Some parts of your portfolio might grow faster than others or decline more during a downturn, and that can throw your original asset allocation out of whack.
Out of whack. Yeah, I can see that happening.
Right. So rebalancing is about periodically buying and selling within your portfolio to get back to your target percentages.
So let's say I have a target of 70% stocks, 30% bonds. But after a market downturn, my stocks have taken a bigger hit.
Right. So you might sell some of your bonds, which have probably held up better,
Yeah.
and use that money to buy more stocks while they're cheaper.
Interesting. So you're using the market volatility to your advantage. You're selling high and buying low within your own portfolio.
Exactly. And this can also be a good time to look for opportunities in sectors that you believe in long term. Maybe a sector that's been beaten down but still has strong growth potential.
Okay, so thinking beyond just those broad categories of stocks and bonds and looking at specific sectors.
Right. One sector that kept coming up was the AI sector. It's had some corrections recently, but many experts believe it still has strong long-term tailwinds, meaning the underlying trends suggest it's going to continue to grow for many years to come.
So rebalancing could mean shifting some of my portfolio towards those AI stocks if I believe in that long-term story.
Right. And it's not just about looking back, it's also about looking ahead, trying to identify what the next big growth area might be. One analyst was talking about the potential of robotics.
Oh yeah, robotics. Huge growth potential there.
Yeah, and he specifically mentioned a company called Intuitive Surgical. They are a leader in the field of robotic
I
surgery.
heard of them, yeah.
Yeah.
Very innovative company.
Exactly. And another strategy is to look for companies that might be undervalued right now because of the overall market sentiment, but have strong fundamentals.
So they're getting caught in the downdraft, even though their business is actually doing well.
Right, like Toll Brothers, the home builder, they've got a huge backlog of orders and they've been buying back their own shares, which suggests they believe their stock is undervalued.
Interesting. And the housing market is always going to be there.
Right. And they could also benefit from interest rates potentially coming down.
Okay, so it's about looking for those diamonds in the rough,
Yeah.
those opportunities that might emerge during these market dips.
Yeah, and it's about shifting your mindset from focusing on the losses to actively looking for potential future growth.
It's kind of like being a treasure hunter.
I like that analogy.
Okay, so to wrap things up, it seems like the main takeaway here is that market fluctuations are a normal part of investing. There are going to be ups and downs, but how you react to those swings, that's what really matters. And that reaction really depends on your time horizon, how close you are to retirement. If you're closer to retirement, maybe it's time to get a little more conservative. Focus on protecting what you've built. Make sure you have that chicken money set aside.
Chicken money, love it.
Right. If you're further away from retirement, well, these dips can actually be opportunities to buy low and let it grow. And dollar cost averaging can be a really powerful tool for that. And then for everyone, rebalancing is a way to make sure you're staying on track, taking advantage of those opportunities, and not letting your emotions get the best of you.
Absolutely. A solid plan, consistency, and a long-term perspective. Those are the keys.
Exactly. So as you go about your day, your week, start thinking about those long-term growth trends. Ask yourself, what emerging technologies or shifts in the economy are you most interested in? What could potentially be the next big thing, and how might those trends influence your investment strategy over the next decade? Just some food for thought.
I love it. Yeah, keep those curious minds engaged.
Exactly. And we'll catch you next time on Curious Minds.